Hey everyone, and welcome. Today, we're going to pull back the curtain on one of the most powerful, yet kind of invisible forces in our financial lives: interest rates. We're going to figure out how a single decision can literally ripple through the entire economy and end up hitting your bank account.
It sounds like a riddle, doesn't it? I mean, what could possibly connect the price of your lunch to the biggest loan you'll ever take out? Well, the answer is interest rates. And once you get this connection, you really start to understand how the economy works. So let's dive in with the basics.
At its core, it really is that simple. Just think of money as a product you can rent. When you borrow money for a car or a house, the interest rate is basically the rental fee you're paying. And on the flip side, when you put money in a savings account, the bank is paying you a rental fee for using your cash. That fee, that's the interest rate.
Okay, so where does all of this actually start? Well, our story begins at a single point, like the first tiny ripple in a huge pond. We've got to meet the people making the decisions.
This is the one, the Central Bank of the United States. You've probably heard them called the Fed. Think of them as the guardians of the US economy. And maybe their most powerful tool is the power to set this key interest rate that basically influences all the others.
Now, the Fed is constantly performing this incredible tightrope walk. You see, they have two main jobs, what's known as their dual mandate. Job number one, keep prices stable. That means fighting inflation so your dollar is still worth $1 when you go to the grocery store. Job number two, make sure the job market is as strong as possible. And here's the tricky part. These two goals are often fighting each other. Interest rates are the main lever they pull to try and keep everything in balance.
And here's exactly how that one decision starts its journey. First, the Fed announces a change to its rate. Almost instantly, big banks change the rates they charge each other and, pretty soon, their customers. That change then affects whether businesses, and people like you and me, decide to borrow money and spend it. All of those decisions add up, and that's what either puts the brakes on the economy or hits the gas. So, let's follow that ripple as it starts to get bigger. That initial decision has now left the world of high finance, and it's becoming a much wider wave, crashing right into the real economy, where companies do business and people actually work.
This is the key link in the chain. The banks are the conduit. It's pretty much a direct pass-through. When the Fed's rate goes up, you can bet your mortgage rate is probably going to follow. When it goes down, borrowing suddenly gets cheaper for everybody.
Right, because it's not just about us. I mean, every single business, from the corner coffee shop to a giant car manufacturer, has to borrow money. So what happens to them when the price tag on that money changes overnight?
Well, it has a massive impact on their real-world decisions. You know, if borrowing is cheap, a company is way more likely to take out a loan, maybe build a new factory or hire more staff. But if borrowing gets expensive, they might just shelve those plans. And that right there affects everything from job growth to whether new, cool products get made.
And there is probably no place where this wave hits harder than the housing market. I mean, think about it. Very few people buy a house with a briefcase full of cash, right? So the health of the entire real estate market is almost completely tied to how much it costs to get a mortgage.
Even a small change in percentage points can make a huge difference. Just look at the difference here between a low-rate period and a high-rate one. We're talking about hundreds, maybe even thousands of dollars difference in a monthly payment. That completely changes who can afford to buy a home and who can't.
And that brings us to the final stop on this journey. After traveling through the central bank, financial markets, and boardrooms, that wave finally makes its last splash right in your wallet.
Yeah, this isn't just some abstract economic theory. This is about your money, the debt you owe, and the savings you're trying to grow. It really boils down to this simple trade-off. When rates are high, it's kind of good news and bad news. The interest on your credit cards and your loans goes up, which hurts, but the interest you earn in your savings account also goes up, which helps. And when rates are low, it's the exact opposite. Borrowing is super cheap, but you're earning basically nothing on your savings.
And you're going to see this trade-off play out all over your financial life. We're talking about the return you get or don't get on your savings. It's the cost of carrying a balance on your credit card. It's the monthly payment on your car loan and your student loans. And of course, it's the total cost of that mortgage.
So what does this actually mean for your bottom line? Well, a rate hike can make your credit card debt way more expensive every single month. It could be the difference in affording a new car. And it totally dictates whether your savings are actually growing or just, sitting there.
So there you have it. It all starts with one decision, made by the Fed, and from there, a powerful wave travels through the entire financial system. It influences huge corporations, it rocks global markets, until it finally reaches its destination, your bank account.
And all of this leaves us with one last really big question. And honestly, there's no easy answer.
Low rates can fuel growth and make things more affordable, but they also risk creating bubbles and runaway inflation. High rates can get inflation under control and reward people who save, but they can also slow down the whole economy and really hurt borrowers. Finding that perfect balance is the constant challenge, and it's a debate that truly shapes all of our financial futures.